Hi, good morning, everyone. It's Sean with Paycheck the Portfolio. Hope your November is off to a great start. Hard to believe we're already at the end of another year. Today, I'm going to talk about breaking free from the 9 to 5 trap and replacing that with cash flow to expedite essentially leaving corporate America in 5 to 10 years as opposed to 30 plus years. Um, on the right, I have some pictures of my family I just wanted to share. On the left, obviously, these are old pictures. That's my dad. And on the right, my mom is the young lady all the way to the left with some of my other family members and uncles there, I believe. Um, my dad was 50, my mom was 40 when I was born. I'm 43 now. I have two older sisters, so I basically grew up in a household with three moms, if you consider the age gap between my sisters and I. But what I really wanted to share here is the quote that Warren Buffett has before that, and the talk about finance and how this all relates to time and time with our families because time is so precious. He says, someone is sitting in the shade today because someone planted a tree a long time ago. And that's so true, right? Like, my dad was 71 when he passed away. He worked his whole life and then unfortunately died just a few years after retirement. And I think that that's the story for a lot of people watching my videos, and certainly for their parents or their grandparents. This concept of working 30 years and then retiring, unfortunately, most people pass away pretty quickly after they retire. My mom now is 83 years old. She's a tough lady, but she's had a heart attack and she's broken her hip recently, and she's hanging in there. But time is so valuable, and so that's why I'm trying to front load my paychecks to be fully invested. If you're new to my channel, all of my W-2 income rolls into a brokerage account. I don't live out of a traditional checking account. I invest in the three buckets: long-term growth stocks and ETFs, closed-end funds such as Cornerstone, and high-yield funds that pay cash flow in the form of dividends every week, every month, and every quarter. What that does is it allows me to grow my equity very quick by fully deploying my whole paycheck instead of just the leftovers. And then what's going to happen is that cash flow will snowball and eventually set me free from a 9 to 5 job. So we're going to touch on the mindset of what that will take to make that shift from a dollar in, dollar out banking perspective to becoming a business owner and creating your own business spread so you can expedite um, leaving corporate America to spend more time with your family, to spend more time with your kids. And that's certainly what I'm trying to do with my family of six. I have 17-year-old twins growing up way too quick. I have a 14-year-old and a 10-year-old, right? And those time just seems like it goes by at warp speed. So, if I can serve in my church, serve with my family, go on trips together and care for other people, that's what I'm trying to do. So I'll never retire. I'll just invest my time with my family so we can enjoy each other before we move on to the next life. We'll talk about the mindset shift. We'll talk about my portfolio and growth and model it out. We'll talk about the Fire Model Pro, and then I'm going to answer some questions here as well. But let's jump right into the portfolio for the update that I do every week. Currently, my net account value is sitting at 165,000. My total unrealized gains is sitting at $36,817. Friday was a good day in the market with the rate cut information that came out and the earnings report that came out from Amazon, MSTR, and others. So, good week overall. On the year to date, you can see that currently I'm sitting at 33% time weighted return. The S&P is at 16.3, the Nasdaq's at 22.8. The Nasdaq's coming up quick and it's growing fast with all the AI related technologies and explosion with tech essentially. The Dow's at 11.8 and the Russell's at 11.1 there. If you look at the 1 year, I'm sitting at 41% cumulative return. The S&P's at 19.4, the Nasdaq's at 30, the Dow's at 13, the Russell's at 12. If you look at the 2 year, I'm sitting at 91.7%, the S&P's at 66, the Nasdaq's at 88, we'll call it. The Dow's at 46 and the Russell's at 51. Again, I started to fully live out of my brokerage account in June of 2024. So right about here on the chart. If you look at the 3-year, the NASDAQ's just slowly passed me there. So again, it's got a little bit of a head start on me in this chart, but I'm going to always transparently show what's going on. So happy that I broke 100% cumulative time-weighted return on 3 years. So I'm sitting at basically 100.5% starting just in June of 2024, fully living out of the brokerage account. The S&P is at 82.2. The NASDAQ's at 118. Like I said, it's been on a tear the last, I'd say about month and a half. The Dow's at 53 and the Russell's at 42. If we click on the historical values tab, this shows inflows and outflows of cash. So money being added, money being spent, and basically the growth of the net portfolio. This is not my gross portfolio. This is the net portfolio balance for me. So over the last 1 year, starting in November of 2024, my beginning value was $102,538. While fully living out of the brokerage, I'm sitting basically at $165,000. So $62,446 has been the increase while I'm fully adding my paycheck every 2 weeks, while I'm fully living out of the brokerage account. And just to give some additional color, my family and I, we went on a trip to Japan in June of this year, and you can see my portfolio balance actually went up. We spent about $13,000 on that trip. It was pretty expensive. I have a special needs son that really loves traveling to, he's always wanted to travel to Japan. So, we spent a lot of money in Japan, and my net account value actually went up while we were on vacation. So that's the power of compounding cash and compounding your whole paycheck versus the leftovers. So let's jump right into the mindset shift. And so I made some bullets here I'm just going to cover for the structure. On the right, if you need an image to look at how my cash flow works, then that's there for you to reference. We talked about that at the beginning of the video. But really, this is a mindset shift versus traditional old models of investing the leftovers versus a new model of investing your full paycheck. So the traditional path says save, spend, and wait 30 years. I talked about why I'm trying to expedite that with my parents and my family and my kids and all those close to us, which we can relate to, right? So the paycheck to portfolio path is invest, reinvest, compound, and accelerate that 30-year time frame. We're replacing your paycheck with income producing assets and equity, essentially, not hope. We're taking a tried and true method of investing that compounds over 30 years, and we're front loading that with the whole paycheck up front. There's the 3 bucket system, which I talk about a lot in all of my videos. The core structure of P2P, which stands for paycheck to portfolio, obviously. So I invest in the growth bucket, long-term growth stocks such as SPYG, McDonald's, Costco, and others. The compounding bucket, and again, these are both compounding really obviously between growth and closed-end funds, but I invest in Cornerstone, which drips at the net asset value. So they pay an 18% dividend. Right now, they drip at a 20% discount to their NAV price. And then every year they do a rights offering where you can sell high and buy back low if you know how to play that correctly. I have a video specifically on Cornerstone in my YouTube channel if you're interested there. So they expedite compounding if you know how to invest in that fund and to manage it, which we talk a lot about in our membership Discord. The high yield bucket, weekly and monthly pay ETFs such as QQQY, SPYI, YieldMax, and others. These are just a few examples. This blend creates both equity growth and cash flow stability, which covers my monthly living expenses and my margin interest expenses. And I'm treating it just like a balance sheet. So I'm treating income like a business. Every dollar has a job. I direct 100% of my W-2 income into the brokerage account, like we've talked about. I purchase assets that produce dividends and equity, not liabilities. I use margin strategically as working capital, not long-term debt. I'm not looking at it like a credit card and buying a car or anything else like that. I'm looking at it like working capital. to essentially create cash flow. The portfolio operates like a cash flow business, generating recurring income while compounding equity. Margin serves as a temporary cash flow bridge. Borrow short term while underlying assets compound long term. As dividends increase, margin reliance decreases and equity strengthens. Maintain 50% or greater equity to protect against volatility. So I always keep 50% equity or greater, and I maintain put option insurance against a market correction or a crash. I have 2 specific videos on my channel addressing that specific topic if you're interested. Compounding and cash flow integration. DRIP automatically reinvests compounding assets to expand ownership. High-yield ETFs provide liquidity, monthly income for bills, and interest. W-2 contributions fuel new purchases each cycle. Together, these create a self-sustaining flywheel that compounds faster than traditional savings by a lot. And obviously, the compounding curve is impacted. Financial freedom through velocity. You're not saving, you're scaling. You stop living off your paycheck and you make your portfolio your paycheck. You build equity and income at the same time to escape the 9-to-5 trap, and you achieve financial independence through velocity, reinvestment, and controlled leverage, just like every business does that's ever started. If you look at my gross portfolio value here, I'm just showing you a couple examples. So let's say you're a traditional saver at 7%. You invest $10,000 annually. In 10 years, you would have a total of $100,000. At an average return of 7%, your ending value would be $138,000, and you would grow $38,000. It would take you 25 plus years to hit $1 million in that scenario, which is what most people do with their 401ks. And it works because of the power of compounding with time applied to the equation. If you take my system of fully deploying your whole paycheck, in my example, my net income is $132,000 a year. Even at the 7% growth, in 10 years, that would be $1.3 million invested. At 7% growth, the ending value would be $2.6 million, essentially. Total growth of $1.26 million, and it would take about 8 years to hit the $1 million mark. If you take a conservative modeling of my system at 15% growth, I just showed on my 1 year, I'm 39% and higher. At 15%, 132,000 starting, 10-year invested would be at 1.3 as well. But the growth here of 15%, I would be at 2.67 million. Total growth would be 1.35 million, and it would take 6 years essentially to hit the 1 million mark. If you look at my actual returns, which I showed at the beginning of the video in E-Trade with time-weighted return, I believe I'm over 40% because I had dividends roll in last night. But when I was prepping for this video, I was at 39% on the 1 year chart. So if you take that actual performance, and I'm not saying I'm going to get 39% every year, but if you just take my actual performance, I would be at the same metrics, 132,000 a year, $1.3 million invested. If I get 39% growth like I have over the last several years, that's $9 million in ending value and $7.8 million in total growth. And the time would be 3 years to basically hit $1 million. The chart below you can see is my actual gross portfolio numbers. And I know it's a little bit long there, should have rounded those numbers, but you can see starting all the way on the left of December of last year, I was sitting at $171,650 of net value. If you look all the way to right, on October, I'm sitting at $332,491. So you can see how quickly the velocity of cash can work in your favor when you're fully invested. If you're interested in typing in your own numbers or your own scenarios, we have this Fire Pro calculator that's available on our membership Discord. All of my resources are pinned under my pinned comments on the YouTube channel. I have a membership Discord that you can join and type in your own numbers here, and it will spit out a 60-month projection for you on basically when you're set free from your 9-to-5 with equity and dividends, which you can grab again on the membership Discord. You can set up a 30-minute call with me. You can do some white glove training if you would like, that shoulder to shoulder training and coaching with me. And you can also get the free starter kit if you want to know more about my system. But this is the Fire Model Pro. I'm going to have this posted in the membership Discord. This is taking a $50,000 starting portfolio value and starting out with zero margin and basically floating your mortgage and seeing what the impact would be with the mortgage float and when you could break free from paying your house bill and then scale in further to the system. But that is available, and I will have that uploaded to the YouTube documents within Discord. Looking at the questions, I always answer questions at the end of these long form videos on the weekend, and we have some good ones I want to get to. So Warren Beans asks, understanding how high yield funds work. And so on the right, I know it's a little bit of a busy screen here, but I want to make sure I cover everything. On the right, a covered call fund like YieldMax generates income by using options instead of traditional dividends. It tracks a stock or an index like Tesla or the NASDAQ and others, right? MSTR, and sells call options on it each month. They use synthetic positions to mimic those actual holdings. The options premiums collected become monthly payouts to investors. So this strategy provides high consistent income even when the market moves sideways, but it caps upside gains if the stock rallies sharply. In short, it's a way to turn market volatility into monthly cash flow without having to trade options yourself. They're doing an option strategy that's been around for many years that individual investors run and simply applying that strategy. Now, you're going to hear a lot of people talk about NAV erosion and how these funds erode on paper and they're bad investments. I've done a specific video on NAV erosion, fact or fiction, if you want to check that out in my channel. Below, I grabbed the Morningstar performance charts of NVIDIA. That's a YieldMax fund. You can see the dotted line there and the return on NVIDIA versus the index when you include dividends back in. So NVIDIA is blowing the index away and the category away when you include dividends. I grabbed Roundhill. Again, you can see the Roundhill funds outperforming the index with the dotted line and the category when you include dividends. And then I grabbed a polarizing Misty because it's been on a downward trend lately. But Misty as well has blown away the index since it launched. And I have two highlighted parts of the chart there. Obviously, if you invested initially early on, you're a happy camper because it's returned most of your money and more, and it's outperforming. If you invested at the top of the chart, you're thinking Misty is the worst fund that ever exists. And so context matters when you talk about these funds and when you're talking about NAV erosion and your perception of these funds. And that's true of any investment that you make. If you have a bad timing or you buy at the top, then of course, a fund that may be great for others might not be so great for you at that point in time. And so sometimes you have to give things time, right? We talk a lot in the Discord about owning a rental home and how these are similar to rental home ownership. If you buy a rental home, the point is equity appreciation over time. That's why I have the three buckets. And then cash flow, so you can pay bills and to live free, essentially. So you wouldn't buy a rental home, replace the roof the next year, and then sell the rental home the following year, unless there's some crazy equity appreciation going on in the market, and then turn around and say that was a bad rental home investment. You have to give these funds some time. They're not long-term growth stocks. They're high yield cash flow producing assets. So that's the way I treat them. Another member here or follower, Daniel, says, what's the eventual transition strategy from a margin bridge to full dividend coverage of expenses look like? You can see that on my Fire Model Pro. It actually shows you where that crossover happens to where your non-drip dividends exceed your monthly living expenses. The calculator is built to pay down your margin balance. But the truth is I worry less about the margin flow and more about my equity position, right? I'm more concerned about growing my gross equity month over month and my net equity month over month than I am about paying down the margin. I treat it like a capital investment. I'm not going to sell my company just so I could pay my original SBA loan, right? I want to pay down the SBA loan or manage the SBA loan constructively, but I'm more worried about growing my business than paying down the initial leverage that grew the business in the first place. So again, it's a shift in mindset from a traditional investor, and then thinking about margin like a credit card. It's not. I'm looking at margin like a capital investment for any business that's growing the equity in the business and the cash flow in the business. And I'm simply trying to expedite that equity curve, which will set me free. But if you want to see the exact numbers, that's available. Again, all of my resources under the pinned comments here below any of my video. I know that this was a deep dive and a lot to go through today. I hope you found this video useful. If you did, please like and subscribe, and we'll talk to everybody soon. Have a great day. Bye.